Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know. First, U.S. Treasury's $20 billion bet on the Argentine peso falters, pitting Treasury Secretary Bessent against Wall Street consensus. We'll examine how this high-stakes currency intervention creates a risky new foreign policy tool and blurs the line between policy and speculation. Second, U.S. China deal eases auto chip ban, but a one-year pause on rare earth starts a critical race for Western supply chains. We'll explore how this temporary truce reveals deep supply chain vulnerabilities and what it signals for the next phase of strategic competition. Third, ex-Goldman exec champions an offensive bond strategy as new private credit ETFs spark warnings of a dangerous liquidity mismatch. In this episode, we'll break down the critical development in fixed income investing and what it signals for both returns and systemic risk. In a move shaking up international finance, the US Treasury has made an unprecedented bet on Argentina's economy, intervening directly to prop up its struggling currency. This includes establishing a massive $20 billion currency swap line, giving Argentina access to a war chest of US dollars. So the thing is, this intervention is widely seen as a direct counter to China's growing financial influence in Latin America. For years, China has been extending its reach through its own currency swaps. In fact, Argentina itself recently renewed a $5 billion swap line with Beijing. The US is now deploying its own rapid financial tools, framing this not just as a bailout, but as a new front in a strategic economic rivalry. The intervention was designed to back Argentine President Javier Milei, an ally of the White House. Politically, it worked, helping his party gain ground in recent elections. But financially, it's a whole different story. This actually creates a new kind of policy tool, which some on Wall Street are calling the Bessent put. It signals that the US might step in to save the economies of its strategic allies. The risk, however, is what economists call moral hazard. It could encourage other allied countries to take on risky economic policies, assuming the US will just bail them out if things go wrong. And despite the US stepping in, the Argentine peso has still fallen roughly 30% this year. The gamble so far is not paying off. At the center of this high-stakes drama is US Treasury Secretary Scott Bessent. The irony is staggering. Bessent is the famous currency trader who once helped break the Bank of England by betting against the British pound. Now, he finds himself on the opposite side of the trade, defending a failing currency against market forces. Believe it or not, this move is so unusual because it uses a special government coffer called the Exchange Stabilization Fund, or ESF. This fund, which holds tens of billions of dollars, is traditionally used to stabilize the US dollar, not to make directional bets on a foreign currency. Using taxpayer-backed funds for what looks like proprietary trading blurs the line between public policy and private speculation, raising serious questions about accountability. Bessent has publicly declared the peso undervalued and promised there will be no taxpayer losses from the intervention. But the consensus on Wall Street is the exact opposite. Most analysts argue the peso is dangerously overvalued, propped up by artificial support that isn't sustainable. And the data really does support this skepticism. Argentina is trying to hold its currency within an official trading band, but its foreign currency reserves are critically low, and even the IMF has expressed concern. Analysts point to Argentines flooding into neighbouring countries to shop as proof their money is being held at an artificially high value. This is a classic sign of an overvalued currency. When your money buys you far more abroad than it does at home, it means the exchange rate doesn't reflect economic reality. This puts the US Treasury in a difficult position, potentially holding billions in a currency that could collapse. The core conflict now rests on Bessent's shoulders. He must decide whether to double down on this risky bet or to cut his losses. The stakes are incredibly high because if the peg breaks and a forced devaluation occurs, it will likely trigger a sharp spike in inflation for Argentines and crystallize major losses for the US Treasury. The key indicator to watch going forward will be the level of Argentina's foreign reserves. If that number continues to drop, the pressure on Bessent to abandon this gamble will become immense. Speaking of Treasury Secretary Bessent, he's also been at the center of another major development in US China relations. A trade war that threatened to stall global car production just hit a major turning point, with the White House confirming a new deal with China to ease its export ban on automotive computer chips. This comes after giants like Volvo and Volkswagen warned that a shortage could lead to plant shutdowns. This move fits the pattern of managed competition we've discussed before, a narrow fix, not a grand thaw. The specifics of this deal are where the real story is. The focus here is on so-called legacy automotive chips, the mature, less complex chips that run everything from your engine to your power windows. Interestingly enough, while the West leads in high-end chip design, China dominates the assembly and packaging of these lower-end chips. This deal reveals a critical vulnerability. By weaponizing its control over these essential components, Beijing has shown it can bring the global auto industry to its knees. It forces Western nations to reevaluate their entire supply chain strategy. This is all happening as Besant made a stunningly frank admission. We don't want to decouple from China, but they've shown themselves to be an unreliable partner. That's the vocabulary of managed competition. Cooperate where necessary, hedge everywhere else. Besant's words carry a lot of weight. This isn't just rhetoric, it's a direct response to recent events that have spooked global companies. For instance, we've seen how China can leverage its control over foreign branded assets on its own soil. This significantly increases the geopolitical risk for any foreign company there and could accelerate the trend of friendshoring to allied countries. Behind that statement, the deal includes some massive commitments. For example, China has committed to buying 12 million tons of US soybeans in late 2025 and a staggering 25 million metric tons in each of the following 3 years. This is a massive reversal, reopening a huge market for American farmers. This decision, however, brings both huge relief for those farmers and comes with an inherent risk. This kind of politically driven deal reinforces a dangerous boom-bust cycle, making the US farm sector incredibly dependent on a single geopolitical buyer. In other words, it creates a short-lived pocket of predictability, helpful for headlines, but not a fix for strategic resilience. This is where the situation takes a more complex turn, entering the realm of strategic national security. As part of the agreement, Beijing will pause its export controls on rare earth minerals for 1 year. These are vital materials for cars, planes, and modern weapons. And that 1 year pause is the crucial detail. It's a temporary tactical truce. To give you some context, China currently accounts for nearly 90% of the global processing capacity for these minerals. So this pause essentially starts a ticking clock. It gives the West a narrow window to frantically build up its own mining and processing capabilities, while China will likely use the year to solidify its dominance. We should now be watching for new investments from the US and its allies to create alternative supply chains, because this truce creates a race against time. So while a deal's been struck, the core conflict is now out in the open, even linking US tariff reductions to China's cooperation on controlling fentanyl precursors. The inclusion of fentanyl is a sign of a major shift, showing that non-traditional security issues are now fully commodified in trade deals. This creates a dangerous precedent, essentially trading economic policy for public health outcomes. The economic handshake is happening, but the geopolitical distrust is now a matter of public record. This complex landscape of geopolitical risk is forcing not just governments, but also investors to rethink their playbooks. And that brings us to our next story, where a shift at the Federal Reserve is completely changing the game in the bond market. A former top executive from Goldman Sachs is telling investors it's time to play offense with bonds. This strategic pivot comes as the Federal Reserve cuts interest rates for the second time this year, taking its benchmark rate down to a range of 3.75% to 4%. Now, get this. Even with this cut, the policy rate is still considered restrictive. Economists talk about a neutral rate of interest, the theoretical rate that neither stimulates nor restricts the economy, and current estimates put that at only around 0.5%. The real implication is that this isn't a full-blown easing cycle. It's more like the cautious mid-cycle adjustment we saw in 1995. The Fed is trying to gently guide the economy, but financial conditions might not loosen as much as people expect. In the wake of this move, the benchmark 10-year Treasury note yield has dropped by almost 2% over the past month, but that's not the whole picture. The bigger story is that long-term interest rates have remained stubbornly high because of something called the term premium, the extra compensation investors demand to lock up their money for a long time. This premium is high because of massive government borrowing and uncertainty about inflation. This matters because it blunts the impact of the Fed's rate cuts, keeping borrowing costs for things like mortgages and corporate debt from falling as much According to Tony Kelly, the former global ETF head for Goldman Sachs Asset Management, this is exactly why the game is changing. The backdrop for this is the end of the TINA era, which stands for there is no alternative. For over a decade, with rates near zero, investors felt they had to pour money into stocks. That era is over. Now, with higher yields, bonds are a real competitor for investment dollars, and the number of new bond-focused ETFs being launched is up 50% from a year ago. If that was just the appetizer, the main course is just being served. Kelly is pointing to specific areas that are heating up, highlighting emerging market debt as one of the top returning asset classes this year. What's happening now is a major divergence. Investors are no longer treating all emerging markets the same. They are carefully differentiating, rewarding countries with strong fundamentals. For instance, research from UBS projects that default rates for emerging market corporates will be significantly lower than for US high yield companies, which helps explain why smart money is selectively hunting for opportunities there. The situation presents a fascinating duality when it comes to the latest financial products. A new battleground is emerging in what are called private credit ETFs. On one side, these instruments are designed to give investors access to institutional style yield with daily flexibility. On the other, they're built on inherently illiquid assets, private loans. You can't just sell on an exchange. This creates the potential for a liquidity mismatch. What happens in a market panic if everyone wants to sell their ETF shares at once? The fund might be forced to sell its underlying loans at fire sale prices, which is why regulators are expressing concern, with Moody's even warning of risks similar to a bank run. Kelly, whose firm BondBloxx already has a private credit ETF on the market, is part of this trend. The message from Wall Street insiders is clear. The once sleepy world of bonds is being remade into an active, offensive arena. So, what should we be watching? The key focal points will be future Treasury refunding announcements and the default rate spreads between different credit markets. These will provide crucial clues about where the real opportunities and hidden risks lie in this new era of bond investing.
That's it for today on Voce Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.